Investing can seem like a daunting task for beginners. The terminology, the risk factors, and the sheer number of options can make the process intimidating. However, starting your investment journey doesn't need to be overwhelming. By understanding some fundamental principles and focusing on a single, beginner-friendly investment option, you can take your first steps toward building long-term financial security. Let's explore how to start investing. Before diving into the specifics, it's essential to understand why investing matters. Unlike saving money in a bank account, investing allows your wealth to grow at a rate that outpaces inflation. Inflation steadily erodes the purchasing power of your money over time, meaning that a dollar today will buy less in the future. Investing counteracts this by helping your money grow faster than the rate of inflation, ensuring that it retains or even increases its value. This growth is powered by compounding, earning returns not only on your initial investment, but also on the returns it generates over time. Imagine investing $1,000 at a modest 7% annual return. After 1 year, you'd have $1,070. In the second year, you're earning 7% on $1,070, not just the initial $1,000, and the cycle continues. Over decades, this compounding effect can turn a small initial investment into significant wealth. This is why starting sooner rather than later is crucial. Investing isn't just about accumulating wealth, it's about securing your future. Whether your goal is to retire comfortably, afford significant life milestones, or build financial independence, investing is a tool that helps you achieve these aspirations. It's not merely a way to grow your money, but a means to achieve financial security and peace of mind. Exchange-traded funds, ETFs, are widely regarded as one of the best investment options for beginners. An ETF is a collection of securities, such as stocks or bonds, that you can buy or sell on a stock exchange. They combine the benefits of diversification, simplicity, and affordability, making them an excellent entry point for new investors. One of the golden rules of investing is not to put all your eggs in one basket. ETFs automatically diversify your investment across a wide range of assets. For example, a popular ETF like the SPDR-S and P500 ETF includes stocks from 500 of the largest companies in the US spanning multiple industries. If one sector underperforms, others may compensate, reducing your overall risk compared to buying individual stocks. Cost matters greatly in investing. ETFs often have lower fees compared to mutual funds, which means more of your money stays invested and working for you. These fees, known as expense ratios, can seem small but add up over time. For example, an expense ratio of 0.1% on a $10,000 investment means paying just $10 annually, a small price for the benefits of professional management and diversification. ETFs are highly accessible to beginners. You can purchase them through most brokerage accounts, often with no minimum investment requirement. Many modern platforms also allow you to buy fractional shares, meaning you can start with as little as $10 or $20. This accessibility eliminates the barrier of needing a large sum to get started. ETFs disclose their holdings daily, so you always know what you're investing in. This level of transparency can provide peace of mind, especially for beginners who may feel uncertain about where their money is going. Let's break down the process of investing in ETFs into manageable steps. This guide will take you from understanding the basics to making your first investment. Before investing, identify what you hope to achieve. Are you building a retirement fund, saving for a significant purchase, or simply growing your wealth over time? Your goals will influence the types of ETFs you choose. For instance, if you're 25 years old and saving for retirement at 65, you may call for stock-focused ETFs, which tend to offer higher returns over time despite short-term volatility. On the other hand, if you're saving for a house down payment, you'll need in 5 years, you might require more conservative bond ETFs to preserve capital and reduce risk. Investing is most effective when you have a solid financial base. Start by creating an emergency fund with 3 to 6 months' worth of living expenses. This fund acts as a safety net, ensuring you won't need to sell investments prematurely in case of unexpected expenses. That's useful if you've invested all your savings in ETFs and an emergency arises, such as a medical bill or car repair. Without an emergency fund, you'd have to sell your investments, possibly at a loss if the market is down. By maintaining an emergency fund, you protect your investments and give them the time they need to grow. To buy ETFs, you'll need a brokerage account. Many online platforms offer user-friendly interfaces, educational resources, and low fees, making them ideal for beginners. Popular options include Vanguard, Fidelity, and eToro. These platforms often provide tools like portfolio trackers and research reports, helping you make informed decisions. When selecting a platform, pay attention to transaction fees, account minimums, and whether they offer fractional shares. For example, if you're starting with $100, a platform that allows fractional shares enables you to invest in high-priced ETFs that would otherwise be out of reach. Research different platforms and choose one that aligns with your needs. With thousands of ETFs available, it's essential to research your options. Start with broad market ETFs like the SPDR S&P 500 ETF, SPY, or Vanguard Total Stock Market ETF, VTI. These funds provide exposure to a wide range of stocks, offering diversification and stability. Pay attention to key factors like expense ratio. This is the annual fee charged by the fund. Lower expense ratios mean higher net returns. Performance history. While past performance isn't a guarantee of future results, it can give you an idea of how the ETF has performed in different market conditions. Look for consistent performance over several years. Dividend yield. Some ETFs pay dividends, which are portions of a company's earnings distributed to shareholders. Reinvesting these dividends can accelerate the growth of your investment. Once you've chosen an ETF, it's time to invest. Decide how much you want to invest and place an order through your brokerage account. You can purchase ETFs in shares or fractional shares depending on your budget. Let's say you've decided to invest $1,000 in the Vanguard Total Stock Market ETF, VTI. You log into your brokerage account, search for VTI, and place a buy order. Depending on the platform, you might need to choose between a market order, buy at the current price, or a limit order, set a maximum price you're willing to pay. Once your order is executed, you officially own a piece of the market. Dollar cost averaging is an effective strategy for beginners. It involves investing a fixed amount of money at regular intervals, regardless of market conditions. Like investing $100 every month into your chosen ETF. By doing this, you'll buy more shares when prices are low and fewer when prices are high, reducing the impact of market volatility. This strategy also instills discipline, as you're consistently investing without trying to time the market. Over the long term, dollar cost averaging can lead to a lower average cost per share and smoother investment performance. While ETFs are designed to be low-maintenance investments, it's still important to review your portfolio periodically. Check whether your investments align with your goals and risk tolerance. If one type of ETF becomes overweighted in your portfolio due to market performance, rebalance by adjusting your contributions or reallocating funds. Investing is not a one-time activity. It's a long-term commitment that requires patience, consistency, and discipline. The stock market can be volatile, and it's normal to experience fluctuations in the value of your investments. During market downturns, it might be tempting to sell your ETFs and avoid further losses. However, history has shown that markets tend to recover over time, rewarding those who stay invested. Think of investing like planting a tree. You nurture it with regular watering and give it time to grow. Pulling it up to check its roots only stunts its growth. Trust in the process and focus on your long-term goals. The compounding effect works best when left uninterrupted. It's also important to avoid being swayed by sensational headlines or advice from unreliable sources. Stick to your strategy and don't chase trends that promise quick gains. Investments that seem too good to be true often carry significant risks that can undermine your progress. By focusing on ETFs and maintaining a steady plan, you can avoid these pitfalls. Educating yourself is a crucial part of becoming a successful investor. While ETFs are straightforward compared to other investment options, continuing to learn about market trends, economic indicators, and portfolio management will enhance your confidence. Many brokerage platforms offer free resources, including tutorials, articles, and webinars tailored to beginners. You might also consider reading books on investing or following credible financial experts. Understanding the principles of investing, such as risk management, diversification, and market cycles, empowers you to make informed decisions. Remember, the more you know, the better equipped you are to handle challenges and capitalize on opportunities. Starting your investing journey early offers immense advantages. The power of compounding is amplified the longer your money is allowed to grow. Consider two investors. One starts at 25 and the other at 35. Both invest $5,000 annually at an average return of 7%. By age 65, the earlier investor will have more than $1 million in account, while the other will only have a little more over $500,000, even though both contributed the same amount every year. This difference illustrates why time in the market is more valuable than timing the market. If you're hesitant to start because you feel you don't have enough money, remember that small, consistent contributions can make a big difference over time. The key is to take the first step and build the habit of investing. Investing in ETFs is an accessible and effective way to begin building wealth. By focusing on this beginner-friendly option, you gain exposure to a diverse portfolio with minimal cost and effort. Start by setting clear financial goals, establishing a solid foundation, and choosing the right brokerage platform. Research ETFs that align with your objectives, make your first investment, and embrace strategies like dollar-cost averaging to build consistency. As your portfolio grows, periodically review and rebalance it to stay aligned with your goals. Most importantly, remain committed to your plan and resist the urge to react to short-term market fluctuations. Investing is a marathon, not a sprint, and patience is often the most valuable asset you can have. By starting today, you're taking the first step toward a more secure financial future. With time, discipline, and a clear strategy, you'll watch your investments grow, bringing you closer to your dreams and aspirations. Remember, every great financial journey begins with a single, deliberate step. Take yours now.